Thanks, Bob. So John's a stockbroker, recently passed away, goes to meet his maker. Angel greets him at the pearly gates, says, John, I've got some good news and some bad news for you. Which would you like first? John says, well, might as well give me the bad news first. Angel says, sorry, but you didn't do enough good things to get into heaven. Oh my goodness, what could possibly be the good news? Well, you didn't do enough bad things to go to the other place. Well, what happens to me now? He says, well, actually, it's not too bad. We let you go visit both places, and then you get to decide where you want to go, and we'll let you go to either place. There's only one caveat, that once you make your decision, it's irrevocable. Where would you like to go first? John says, let's go visit heaven. Angel snaps his fingers, and there he is. Whatever you might imagine heaven might be, this beautiful pastoral setting, angels flying around, whatever you might think. Comes back, Angel says, what do you think? Oh, it's just beautiful, just what I imagined. Love it. And says, well, you want to go visit the other place? So, yeah, I might as well. I have a choice. Can't hurt. Go look. Goes down. Angel snaps his fingers. And there he is, kind of like Las Vegas. Wine, women, dancing shows, golf courses galore, everything he's ever loved to do. Comes back. Angel says, what do you think? Says, I told you heaven was really nice, but that other place I think is more like me. I think I'd rather go. You're sure? Because it's irrevocable. Absolutely. Snaps his fingers, and this time the devil's there to greet him. It's 120 degrees, 99% humidity. Everyone's banging on rocks with hammers and chains on. And John says, what's this? And the devil says, yesterday you were my prospect. Today you're my client. In all good humor, there's a lot of truth, right? So, anyway, tonight's talk, the quest for alpha, and just for those of you who aren't familiar with the term, what that means is returns that are above an appropriate risk-adjusted benchmark. So buying stocks and getting, say, 8%, and you said, well, I generated alpha because bonds got 3, that's not alpha. If you buy risky, small stocks in emerging market countries and you got 12% and you said the S&P got 10, that's not alpha if small cap stocks in emerging markets got 15. So you have to make risk-adjusted benchmarks. And in the world of investing, alpha, outperformance against appropriate benchmarks, is the holy grail, and that's why I use that title for my book. And so we have two theories really about investing, and that's what we're going to talk about tonight. Two theories are conflicting. The first is that markets are inefficient. That's the conventional wisdom. I'd be willing to bet that the vast majority of the people in this room, especially those who haven't read my books, believe that this is true. Conventional wisdom, I would say, are ideas that are so accepted they go unquestioned by most people. And by inefficient, what I mean is that markets misprice securities on a persistent basis. And if that's true, then the way you add value is either by what we call stock selection. Okay, Intel is trading at 20. I think it's worth 30, and I tell you as your broker or advisor, we need to load up on Intel. Or Intel's trading at 20, and I tell you it's really worth 10, and therefore we want to avoid Intel, or if we're really aggressive, we want to short it, meaning betting it will go down in price. Okay, that's the art of stock selection. And smart people working hard, all these gurus on TV, that's what you hear. There's a second part of this theory is that those same people working hard can somehow identify when the bull is about to enter the arena, time for you to load up, raise your equity allocation, and they can also tell you when the bear is about to emerge from its hibernation, time to get out of stocks. So if you're really aggressive, go short, bet that they'll go down. That's called the art of market timing. Collectively, that's the art of active management. If that's the right theory, then the winning strategy is really simple. You identify these gurus very simply. You look at their past performance, see who has generated alpha. It's very easy to do. All you need is a database. You can look at Morningstar's rating system if you don't have your own database. Read Money Magazine, Smart Money. They'll tell you who is the best managers in the last 10 years, etc. That's probably what almost everybody in this room believes to be true. Okay, that's why it's called the conventional wisdom. However, there's another theory based on about 60 years of academic evidence now called modern portfolio theory, body of evidence that includes what's called the efficient markets hypothesis. And it says that markets are efficient. Now, what that means is, and this is very often misinterpreted, misquoted by many of the people you hear on TV, they'll tell you, how could market prices be right? You know, high-tech stocks were trading at such crazy levels in 1999 and they eventually collapsed. The efficient market theory, in nowhere does it say that the market price is the right price. What it says is that the market price is the best estimate of the right price. We don't know what the right price is, okay? And if that's true, that the market price is the best estimate of the right price, then efforts to outperform are unlikely to prove productive after the expenses of the effort. Okay? Doesn't mean it's impossible to beat the market, but you're unlikely to do so. Okay? And if that's right, the winning strategy is entirely different. The people who are here are all trying to focus on managing returns. I like to say that's the only thing you can't control. So why are you focusing on it? There's only one person who knows where the market's going. And unfortunately, in this lifetime, if I talk to him and ask him about it, he won't tell me. And the next lifetime, it won't do me any good anyway. Instead, if this is right, what we want to focus on the things we actually can control. How much risk we want to take, the fund construction, meaning the types of funds we buy, costs, making sure they're as low as possible in general, and tax efficiency, making that as high as possible. Okay? So, we don't know which of these two strategies is the right one. We have these two theories. And how do you know which is the right one? They're entirely different conclusions. And the problem is that unless you get an MBA in finance today, the odds are great that you've probably never taken one single class in capital markets theory. It's a disgrace. Our education system has failed people. So they, despite the fact that money is the third most important things in our lives, I like to say, after your family and your health, there's nothing else more important. It's not money in itself, of course, but what money does for you. It allows you to retire well, have financial security, take the trip to visit the grandkids every year, donate money to your favorite charities. Whatever it is that's important to you about money, that's what's important. And yet the education system has entirely failed you, right? How do you know which is right? And unfortunately, we have a situation where we have this conflict of interest. Wall Street and the media need you to believe that markets are inefficient, so you pay them big fees or tune in. So they're going to tell you that's the right strategy, okay? So what the job of the talk tonight in my book is to look at the academic evidence, okay? Imagine that the men here in the room had just come down from Mars and the women from Venus, and you don't know, you hear these two theories. How do you know which is right? Well, if you're smart people, what do? You look at the academic research, and you see, just as if you have a medical problem, you don't go to Ladies' Home Journal, you go to the New England Journal of Medicine. So what we're going to do is look at the academic research tonight, and then you can decide for yourself which of the two theories are right. So we'll begin by asking this question, are the markets inefficient? Okay. If markets are inefficient, again, meaning that prices are wrong, and we can exploit them by buying stocks that are undervalued and avoiding ones that are overvalued, we should see evidence of this, that there's persistent ability to outperform risk-adjusted benchmarks. And the persistence, very importantly, must be greater than randomly expected. Let me give an example. Let's imagine we have 100 people in this room and we declare a coin flipping contest. The winner we'll name as the guru coin flipper. Okay? And what we say, everyone stands up and you flip a coin. If you flip heads, you remain standing. You flip tails, right? You sit down. After one round, we'd expect to have 50 people. 2 rounds, 25, 3, say 12, then 6, then 3, then 2, and 1. So roughly after 8 rounds, we'd have a winner. And let's say it's my friend over here, Frank. Anybody here want to bet Frank wins the next coin flipping contest? What do you think? Right? There's no skill there. It was random luck. So we actually have roughly 10,000 mutual funds at the peak of the number of funds. Okay? You would expect randomly 5,000 to beat the market in any one year, 2,500 after 3 years, 1,250 after the third year. That's the equivalent of flipping 3 heads in a row, and yet if you beat the market 3 years in a row, you're declared a guru, you're on the covers of Morning Star's publications, Money Magazine, you're on CNBC, and you're asked for your views, and you're a coin flipper who flipped 3 heads in a row. You need to see evidence of persistence beyond what we would expect randomly. It's easy to identify past performance. All we need is database, as I said. The question academics ask is the past prologue? And there are ways to look at that. Good statistical studies. So we're going to look at the evidence in 5 areas. My book actually covers a 6th called The Field of Behavioral Finance. We don't have time to go into that tonight, time limitations, but we'll look at 5 of them. Mutual funds, pension plans, hedge funds, these guru geniuses, venture capital, and individual investors, people like you, especially the members of the AAII. So let's begin by looking at the evidence from the field of mutual funds. And there are literally hundreds of studies on this subject. This is probably the most studied field of all of modern finance. I obviously can't list all 100. I've chosen 2. But all of the studies virtually come to the same conclusion. Certainly is an overwhelming preponderance of evidence. The first study was done by a fellow named Mark Carhart about 15 years ago now. It was the first major study that eliminated what we call survivorship bias. Looked at over 2,000 funds, and he found over a 33-year period that the average actively managed fund underperforms its appropriate benchmark before taxes by almost 2% a year. You make it, when you include taxes, it's worse than 3. Okay? Now, anybody here, whenever I say this, by the way, the people say, I don't buy the average fund. Anybody here ever buy an average fund? Raise your hand if you bought an average fund. You're all living in Lake Wobegon, right? You all buy only above average fund, right? But that's what people do. No one buys funds that have lousy track records when they buy them. They own them when they have lousy track records, but they don't buy them when they have them, right? That's what the evidence shows, and you'll see a lot more of that. A recent study by 2 professors, Pham and French, probably now the 2 most cited academics in the world of finance, they looked at a study that looked at this statistical test that I just walked you through with the coin flipping. Similarly, they looked at the question of luck versus skill in the cost section of mutual fund returns. What they did is something called bootstrap simulations. They had a computer take all the returns and just randomly choose them. And what they found is that very few funds outperform what we do purely by randomly selecting returns from the actual data. Certainly not enough to cover their costs. Literally, there are hundreds of studies that say exactly the same thing. I cite a few more in my book for those of you who are interested. One of the questions I like to show people is this. Gee, Larry, in every field we know that if somebody's good, like Roger Federer, greatest tennis player maybe of all time, that can't be luck, right? Albert Pujols played here at Peoria, right? Greatest player maybe in the history of baseball in the first 10 years of his career. Certainly the best hitter ever the first 10 years of his career. That can't be luck. So why can't be luck on investing? It has to be skill if it's long-term performance. The problem is they don't understand that we're talking about 2 entirely different games. Now, I don't have time to go into the whole story. For those of you interested, I wrote a book called Wise Investing Made Simple that has 27 stories that explain some of this stuff. But one-on-one competitions, very small differences in skills lead to huge differences in outcome. Roger Federer plays Andy Murray. How much better is Roger Federer than Andy Murray in the big scheme of things? About that much better. And yet if they play 100 times, Roger Federer wins 98 of them. If I sit down to play bridge with Don, or chess, let's say, one-on-one, and he's this much better than me, he wins 90% of the games. In the world of investing, it's not one-on-one competition. If Don is competing to me to pick stocks, maybe he does a lot better because he's a lot smarter than me and he can exploit me. What people don't understand, if Ralph here is buying a stock, he should ask the question, which I bet Ralph never asked. Did you ever buy a stock, Ralph? A few. Let me ask this question. Did you ever ask yourself, who sold me that stock? Did you ever think about that? Right? You never thought about it, right? Right? So we'll have a little, Ralph, if you don't mind helping me here, and think about yourself in this situation. So Ralph bought the stock. Give me a name of a company. Doesn't matter.
Caterpillar.
Caterpillar, okay? So Ralph buys Caterpillar, and he thinks of 50 great reasons to buy Caterpillar stock. And he goes and buys it. Now, for everyone who bought a stock, someone's got to be a seller. We only have two types of investors for our purposes here. Individuals like Ralph, and big institutions, mutual funds, hedge funds, pension plans. Okay? Who do you think does more of the trading? Which group, Ralph?
I think individuals.
Individuals? You're not even close. It's about 90% institutional investors. Which means that if Ralph is buying the stock, there's a 90% chance the seller was somebody like Morgan Stanley. Now, there's only one reason, whatever Ralph thinks, that logically why he should have bought the stock, right? Because it would outperform. He may, give you 50 good reasons, but there's a lot of risk owning one stock. You can get rid of that risk by owning a total market fund that owns 7,000 stocks. So he's got to be highly confident it's going to outperform. On the other hand, if Morgan Stanley, say, sold him the stock, there's only one reason they would have sold it, right? Why? Because they think it's going to underperform. Now, logically, Ralph, who do you think knows more about the company? You or Morgan Stanley or the guys at Goldman Sachs or whatever? The institution. So you just made a bet where you know only one of you can be right, and you just told me you think the other guy is more likely to be right. Something wrong with that picture? Anybody here? What's the saying about a poker game? If you're sitting at the table and you can't identify the sucker, who is it? See, the problem is 90% of all trading is done by institutional investors. Where are the victims that you're going to exploit? There aren't enough of them. And here's the more interesting thing. Say Morgan Stanley sold them the stock. Where did they get it originally from? Maybe Merrill Lynch. Merrill Lynch bought it originally because they thought it would outperform. They sell it to Morgan Stanley now because they think it'll underperform. Morgan thinks it's going to outperform. How many of them can be right? One, and both of them are spending your money. And why would you think Merrill's any smarter than the guys at Morgan Stanley? Anybody got an answer for that one? That's a real problem. So coming back to this question here, okay? I asked the question, how long is long enough? They say, Larry, it can't be luck. 10 years outperforming the market, it can't be luck. I say, I'm sorry, but you don't know statistics. So I pull out, in my book, I give, I think, 4 or 5 examples. I'm going to give you a few here. Bill Miller, Leg Mason, had outdone what Warren Buffett and Peter Lynch could not do. He beat the market 15 years in a row. Can't be luck, can it, Martin? 15 years, it can't be luck. No one would think Albert Pujols' first 10 years are luck, right? So let's see if it can be luck. Okay? That fund beat the market every year from 90 to 05. Then the index beat them by 10% a year over the next 5 years. The 10-year performance now was so bad it underperformed the S&P by 3.3% a year. Now, there's only 2 possible explanations for that story. Either Bill Miller was lucky in the first part and got unlucky in the second, right? Or the other explanation is one day Bill Miller woke up and took a stupid pill. Which one do you vote for? I think it was much more likely to be luck and then bad luck. David Baker, a fund called 44 Wall Street. I'd be willing to bet nobody's ever heard of the fund. Right? Anybody here ever hear of it? We got one. Maybe you read my book. No. So there are 2 people in the room. These guys outlynched the greatest mutual fund manager of all time, who is which? Who's the greatest mutual fund manager generally considered of all time? Peter Lynch. In the 70s, people thought he was the greatest manager ever. Wrong. Peter Lynch was only, I think, the third best manager of the decade. The single best manager was, guess who? David Baker. How come you don't know him? Right? By the end of the 70s, why do you want to invest with Peter Lynch? You don't want the third best manager. Anybody here want to invest with the third best manager? We don't buy average guys. We want number one. So we're going to invest with David Baker. In the 80s, it was the single worst performing fund, while Lynch went on to create his great legend and great performance. You're not invested with him because you're invested in David Baker. The S&P went up 400%. Baker turned every dollar into 27 cents. Can't be luck, right? Has to be skill, an entire decade of out-lynching Lynch. There are other horror stories like that. I'll let you just, well, maybe, can everybody read that back here? I know it may not be clear, so I'll let you take a moment. David Swenson, Burton Malkiel is one of the leading lights in academics, financial economics, wrote a fabulous book, probably the best-selling book on the markets maybe of all time, called The Random Walk Down Wall Street. Listen to what he has to say about this issue. Here's quotes from David Swenson, the chief investment officer of the Yale Endowment, generally considered one of the greatest investors of all time. Overwhelmingly, mutual funds extract enormous sums from investors in exchange for shocking disservice. And Jack Meyer from Harvard University Endowment Fund, another great track record. The investment business is a giant scam pulling billions of dollars out of your pockets. There's no doubt about it. You should invest simply in index funds, keep your fees low and your taxes down. Legendary investors who have nothing to gain, they're not trying to sell you anything. By the way, anybody know here what the definition of a stockbroker is? Someone whose objective is to transfer money from your wallet to their wallet. Pension plans, let's look at. Now, my thought is that logically, if anyone could beat the market, it should be large pension plans. Why do I say that? First of all, I've sat on the boards of public companies. I've sat on investment policy committees. I've met with many large endowments, pension plans. They control huge sums of money. They pay much lower fees than retail investors. They have access to the best performing managers, managers you and I don't have access to because we don't have $10 billion to give them. They don't pay taxes. Don, if you sat on the board of a pension plan, would you ever hire a manager with a bad track record? Would you take your job seriously? Yes. Yeah, you bet. I've met with they're smart people. They take their job seriously. Actually, the research confirms what Don just said. They only hire managers with great track records. In the 3 years prior to hiring, the funds on average generated alphas of 3%. You're a genius when you get 1% a year. At 3%, you're a legend. That's what they hire. They, in addition, unlike us poor people in this room, after all I say in Morningstar rating system or Money Magazine, they hire the top consultants in the world, firms like Russell and SEI. Russell boasts that they have 70 analysts doing 2,000 interviews a year. They hire really smart people. What advantage do you or your stockbroker or your banker have over these guys? Can anybody think of a single advantage? Smarter than them, work harder at it, have more resources? Russell and SEI alone advise on almost $2 trillion. So obviously people believe they can pick the winners. Goldman's another big player in this space. They do tremendous amounts of due diligence, interviews that you don't get to do, statistical tests, every imaginable question that you could think of, these guys ask it to make sure it wasn't luck. So we can look at the studies to see if these people beat the market, and if they can't, who in this room thinks they have an advantage? Can you name a single advantage you have over them? I've asked that. There is none, right? They will have huge advantages over you. So if they can't succeed or aren't likely to, you shouldn't try. Two major studies. First one looks at 1,000 pension plans. Second one at 3,600 plans. And I want you to focus on this number, because this is the definition of insanity going on here. 9,000 hiring and firing decisions. Let me explain what that means. So you're a pension plan, and you want to build a globally diversified portfolio using the science of investing, and you want to own some U.S. stocks, international, emerging markets, bonds, and within those big asset classes, you want to even diversify further. So in the U.S., you want to own some large and small, value, growth, real estate, maybe some commodities. International, do the same thing. And in bonds, maybe you want to own some emerging market bonds and some mortgage-backed securities, whatever. And you know that no manager is the best at every asset class, right? So you got to hire, say, 12 managers, one for each of these asset classes you want in your diversified portfolio. And so what happens is they hire, say, 12 managers, and typically they may wait, say, 3 years before they check, although they check every quarter and look at reports. They don't fire people after 1 year. After all, 1 year, even Pools has a bad month or even not a great year. We'll wait 3 years to see. That's the typical period. And what do? They find, well, we got these 12 and 6 of them did poorly. We got to fire these guys. And so they fire them and repeat the process. And so I asked this question literally hundreds of times, so I want you to listen carefully. I asked them this. So you fired 6 or 8 or whatever the number is of the managers. Obviously something went wrong because you wouldn't have had to fire them, right? Something's wrong in the process. What are you doing differently this time to make sure you don't repeat the mistake? And you know how many times I've gotten an answer? 0. They just sit there. I said, you know what you're doing is what Einstein said is the definition of insanity, which is what? Repeating the same behavior over and over again and expecting a different outcome. 9,000 times they repeat. How many times do you have to bang your head in the wall before you figure it out, right? The head must awfully be pretty painful at that point. So here's what they found. Let's look at the evidence. Prior to hiring, exactly what I told you. They hire managers with great track records. Alphas are 3%. After they're hiring, relative benchmarks, 0 alpha. That's before the transitions costs. Because Martin here hires me, manager A, I do a lousy job, fires me, hires Mike over here to replace me. Mike says, hey, we got to get rid of Larry's stocks. They're dogs. That's why they perform so poorly. We got to buy my cats. They're much better. And so we sell my 2,000 stocks and buy his 3,000 stocks. We got lots of trading costs. Even before those transitions costs, there was no alpha. Interesting enough, the funds they sold went on to outperform the funds they bought. So they would have been better off if they just became Rip Van Winkle and slept. They found no performance beyond the randomly expected, exactly what Fama and French, David Swenson found, and you'll see in other studies. In other words, there may be skill out there, but we can't find it. Because instead of having, say, after 10 years, having 100 managers beat the market for 10 years, we find 1. And there was no way to know ahead of time which the one was. If there was, then you wouldn't have bought David Baker, right? You would have bought Peter Lynch. No, neither fund size nor the degree of outsourcing mattered. So if you hired Russell or you did it yourself, it didn't matter. Didn't matter if you owned lots of company stock. In some cases it hurt, like Enron, might help in Caterpillar's case. And this clearly refutes the claim that large pension plans are handicapped by size. Small plans did no better. In fact, the large plans have some benefit because they can negotiate lower fees. Here's the conclusion that was reached by the studies. Striking similarities in net performance patterns over time make skill differences highly unlikely. Can't say there's no skill. We just don't know how to find it ahead of time. If you could find it ahead of time, you wouldn't have to fire people 9,000 times, would you? Here's what I think is perhaps the most compelling chart in the whole presentation. We use in our strategies the funds of a company called Dimensional Fund Advisors, a fund family that probably most of you have never heard of, despite the fact we're getting close to about 300 billion of assets. How many people have heard of Dimensional Fund Advisors? So maybe 2%, 3% of the audience, right? Why don't you hear of them? Well, they don't deal with the public in an effort to keep their costs down. They create more sophisticated versions of Vanguard's index funds. Vanguard's index funds are perfectly good vehicles. Use them, you'll outperform the vast majority of investors if you stay the course. However, index funds, while being good, there are ways to make them even better. And DFA's academics have found ways using research and some little bit of common sense to actually fairly significantly outperform the similar funds of Vanguard. In my book, The Only Guide to Winning Investment Strategy, Chapter 9 goes into a little bit of the difference between index funds and passive funds. On my blog at CBS Money Watch, which Mike has in his brochure, there are 4 blogs related to DFA versus Vanguard. If you just type that in and search, or you can call Mike and he'll let you know. But at any rate, I mentioned DFA because here we can look at an apples to apples comparison to make sure we're looking at comparables here. All right? So here we look at SEI and Russell. I mentioned to you they had at one point almost $2 trillion before the bear market. They hire the top managers. They're geniuses, right? They do this research. You pay them big fees, or the pension plans do. They then created their publicly held mutual funds so you could benefit. Everybody's going to win. SEI and Russell collect big fees. They're much more expensive, like all actively managed funds, than DFA's funds. But our clients will win because we're going to get them alpha with these great managers. So let's look at asset classes. I've been doing this now for about the last 6 years. Every year we add one more year on. SEI and Russell against, this is DFA's S&P 500 fund. They don't win here. Well, that's no big deal. Maybe it's hard to win in large cap stocks. The market's so efficient. Hard to discover information about Caterpillar that nobody else knows. And the only way you can benefit is discovering information that no one else has. Doesn't matter if you discover a Caterpillar is a good company. If everybody knows it, it's already built in the price. So let's look at small companies. We say, gee, we can get this big advantage by uncovering information. These moronic commercials from Janus. You see the hotel light on and Janus is looking to check. Yeah, the guys at Morgan Stanley never thought about that. Or they check to see that the pipe someone's putting in these cables under the street. No, the guys at Goldman just couldn't figure out that you should go check to see if that happened. Only the guys at Janus figured that one out. But that's what they're telling you in the commercials, and I guess I expect you to believe it. But look at the evidence. Oops, sorry. Here's the evidence here. Here's SEI and Russell, and here's the DFA fund. This one just buys and owns 2,500 stocks, small caps, no stock picking or market timing. Just ranks stocks, buys them in the market capitalization ranking, and owns them. That's it. Of course, it has much lower fees because you don't need to pay big fees to a computer, right? Large value stocks, the Ford Motors in the world, right? Here's the DFA fund. Here's the small cap value stocks. They don't win here. Gee, how about internationally? Emerging markets, surely we can outperform in these inefficient asset classes. And how about here's some other international? They don't win anywhere. Monkeys throwing darts randomly would expect to outperform half the time. These guys with $2 trillion a year, under management, maybe 2% average, maybe worse, underperformance. That would be $40 billion a year of your money being flushed down the toilet in a triumph of hype and hope over wisdom and experience. There's the data. You don't need a theory. All you have to do is look at the evidence. It's overwhelming. So let's turn to the hedge fund world. All right, these are the big gurus. What we find from many studies on hedge funds, no persistence of performance beyond the randomly expected again. Risk-adjusted returns, they take a lot more risk and claim alpha. It's not alpha. They use a lot of leverage. They invest in highly illiquid securities that are a lot more risky. Once we adjust for these risks and eliminate the bias in the data, they look like treasury bill returns. As I said, they're highly illiquid themselves, which means you should get a big premium for investing in them to compensate for the risk. You don't have access to your money, but they don't outperform T-bills on a risk-adjusted basis. All the trading makes them highly tax inefficient. That makes the data even much worse than I'm going to show you. They lack transparency. You don't even know what they invest in. Could end up with, with Madoff, for example. That's a good enough reason you should never invest in a hedge fund. I wouldn't invest my money in anything. I don't know exactly what the risk they're taking. And they have this incentive structure with 2 and 20%, which creates huge incentives to take risks that do not correlate with what you want. It's called agency risk. Let me explain very briefly. And I've run trading rooms, so I know of what I speak. It's now, you get 2 and 20 as a trader. So you want to hit that bonus, right? And it's come October and you've had not such a great year, you're down 3%. What's your incentive at that point? Anybody know? Take a lot of risk, right? Because if you lose, you just walk away and start another fund. If you make money, then at least you'll get your bonus. It's an I don't lose, I win game for the trader, but not for the investor. So what you see in periods like this, traders go in, take out huge risks. If they get lucky, boy, then they get paid. And if they don't, you go broke. And that's what happens. It's actually, while they're telling you this incentive structure puts them on your side, it actually creates this big risk called agency risk, which they never discuss, and has led to many hedge funds blowing up. So let's look at the data here. I've been doing this for the last several years, adding a year as we go. Since 2003, I started tracking the HFRX Global Hedge Fund Index, which is an index of funds. 2.8% for the last 8 years. Here's every major asset class on the equity side, underperformed dramatically. Imagine building, say, an equally weighted portfolio of all of these asset classes. You obviously slaughter the hedge fund geniuses. They even underperformed intermediate and longer term treasury bonds with no credit risk and barely beat virtually riskless one-year treasury notes. Barely. This doesn't account for tax inefficiency either. There's no there. And yet every year they attract tens of billions of dollars. Here's the evidence in private equity. It's a little bit better. There are several studies I cite in my book I chose for this presentation. The best one to put them in the best light, and it's still not good. Here's the problem. There are all kinds of private equity. Mezzanine financing, typically I'm going to go public in 6 months. I need money to make until I get my proceeds. So I go and get what's called the mezzanine round of financing from a bank. That's pretty safe for the bank because I'm going to pay them out in 6 months or 9 months. Some risk because the IPO market could shut down and I can't access it. That's returned 9.1% a year. Then we look at the S&P 500. That got 11. This is the smallest stocks, 9th and 10th decile. That's Center for Research Security Prices at the University of Chicago. That's really small stocks. That got 11. This is an index of large value stocks. Here's late-stage venture capital, kind of just before mezzanine financing, so a bit more risky. Leveraged buyouts, private equity on average, all the different types of private equity. Venture capital, early stage money, and here's the real early stage money, seed stage. Martin over here has got a company starting in a garage. He wants you to put in 10 grand and he give you 1% of the company. Clearly very risky, and it has outperformed, although the returns look like a lottery ticket. 90% of them blow up and the few hit big home runs. But take a look at this. Private equity on average got 13.8%. They say we generated alpha against the S&P. That's nonsensical, isn't it? These are publicly traded 500 companies, broadly diversified, perfect liquidity, daily transparency. You can get your money out at any time. Very risky companies, brand new startups, not even public yet. All I had to do was buy a Farmer French small value research, which looks like virtually identical to the DFA small value fund, and I outperformed that. And these are less risky than this, because I own maybe 1,500 stocks instead of 10 in any one fund. And they're public companies with daily liquidity. private equity in general pulls the wool over investors' eyes because they don't show the right benchmarks. And this is the best study. I could show you much worse data where they didn't even outperform the S&P 500 over like 50-year periods in one study. And private equity, as I mentioned, investors forego the benefits of liquidity, transparency, broad diversification, daily pricing. Markets go down, I can harvest losses. We were just doing that last week for our clients. Uncle Sam shares the pain. Private equity, you're stuck, you're in a fund for 10 years, nothing you could do about it. The distribution of returns, like I said, looks like a lottery ticket. While the average was 20%, maybe 90% of the people lost money. So the odds are much more likely you're going to lose money than you'll make money. Now the 10% that win big, right? But so the mean doesn't look anything like the average. And to reduce that kind of risk so you don't end up owning a lottery ticket, you need broad diversification, which is possible for a large institution like California State Retirement System. They could put $3 million into 20 different funds, 60 million allocation for them out of billions and billions is fine. And now if they've got 20 different funds, each one with 10 or 15 investments, they got hundreds of investments. Less likely to look like a lottery ticket. It's more likely to be closer to the average. Although to get the average, you got to own thousands of them. Can anybody here do that on their own? You don't have enough money typically to do that and monitor all of that kind of stuff. So now let's look at individual investors. We have people like you. We have a series of studies by Brad Barber and Terence O'Dean, two professors at the University of Chicago. They found this. Even before costs, the stock you buy tend to go on to underperform after you buy them, and the stocks you sell go on to outperform after you sell them. That ever happen to anybody here? The more you trade, guess what? The worse you do. And I would submit to you, the people who trade the most are the ones who have the most confidence in their skills. They wouldn't be trading a lot. Obviously, people have confidence in skills they don't have. The people who trade the most, like day traders, okay, they underperform the market on a risk-adjusted basis by 10% a year. The market only gets 10%. They're taking all the risk of equities and earning cash-like returns. Who's getting rich on this? Stockbrokers, Charles Schwab, TD Ameritrade, that's who's getting rich. Investment clubs, like the members of the AIA, they're worse than individual investors, proving more heads are not better than one. Investment clubs, a study found, underperform the market by 4% a year on a risk-adjusted basis. That means you're getting bond-like returns while taking equity-like risks. And the Mensa Club, these geniuses, top 2% by IQ. Surely if anyone could beat the market, it would be these guys. They underperform by 13% a year for 15 years. I submit that would be impossible to do if they set out to try, except that they just traded a lot and made brokers money. They couldn't pick stocks that badly. One member was asked to explain their strategy. He said it's very simple. We buy low and we sell lower. So we've kind of gone through the evidence. You don't have to believe me. You might look in the law books. They looked at the research 20 years ago and said everything I just told you is true, and now we have hundreds of more studies that make the evidence even more overwhelming. What they said is that there's little or negative payoff when fiduciaries and others try to beat the market, and there's little correlation between earlier successes and future returns, which means you should basically give up on trying to beat the market. You're not likely to do it. Is it possible? Yes. It's possible to win at Las Vegas in the racetrack. Anybody here take their retirement account to Las Vegas or the racetrack? You shouldn't take your retirement account to the Merrill Lynch office either. You have about as much odds of winning as you do at the lottery or the racetrack. Possible, but not likely. The only sure way to win the game of active management is simply not to play it. You do not have to play it. So in summary, as I said, you don't have to play the game of active management. Instead, you can earn market returns, which by definition means you're above average, right? Because the average fund underperforms pre-tax by 1.5% or so, after taxes by 3%. If I just match the market returns, I slaughter the vast majority of investors. I'm much more likely to reach my goals. And by the way, who has a much better time in their life? Your active investor. I come home from my busy day at work, I run to check my computer, turn on CNBC, watch Kramer banging, throwing things, all of this stuff, shouting, screaming, all this stuff. Go to check the charts, pull out my tables, read Money Magazine, check the chat rooms. I come home from my busy day at work, I sit down with my wife, have a glass of wine, ask her how her day went, help my kids with homework, I coach their softball, soccer, basketball teams, I play tennis, do lots of community service like this, a lot of rafting, I read 70 books a year. Who do you think won the game of life? Which is a far more important game to win. So even if you're among the very few who do beat the market, the price may have been you lost a far more important game of life. Oh, by the way, one other thing I forgot to mention. This is really important. Let me say that. We showed you that the stocks that investors buy underperform, right? After they buy them, and the ones they sell go on to outperform. Ma'am, what's your name?
Terry.
Terry. Do you think women can pick stocks any better than men? What do you think? You got a 50% chance of being right.
Yes.
Wrong. They're no worse, though. Now let me ask you a different question. Who gets better returns, women or men? Women, right. But how can that be if they pick stocks just as poorly? They hold more. They don't trade as much. Because you see, men have confidence and skills they don't have. Women know better. By the way, who do you think has better returns, married men or single men?
Married.
Yeah, why? Because they have the sage counsel. They're obviously superior wives, right? Okay, if you invest passively, as I said, you're virtually guaranteed. All you need to do is stay the course. You're virtually guaranteed to outperform the vast majority of investors, both professional and individual. I can prove it to you in 2 minutes. It's all it takes. While Wall Street touts stuff, it's all nonsense. It can't even be true. Here's the facts. All right? I'll show you this simple arithmetic here. The total market is made up of 2 types of investors, individuals who are active and others who are passive, or institutions are active. That's it. Doesn't matter how active you are or how passive, either you're active or passive. Passive investors make up roughly 30% of the invested money, active is 70%. But trust me, it makes no difference. I can make the numbers 99 and 1, 1 and 99, or anything that adds up to 100. Let's assume now the market earns 10%. I own Vanguard's total stock market fund. I'm a pure, simple index passive investor. Before any expenses, there's only one rate of return I can get, right? The market got 10, I get 10. Now, I don't get 10, maybe I get 9.9 because it's got a 10 basis point expense ratio. But it's damn close. All right? If I got 10, since the sum of the parts must equal a whole, what does that mean? That active investors in aggregate must also get 10. So what it tells you is before expenses, active investors in aggregate must get the same return as all passive investors, right? There's no other number it can be. Now, who has higher expenses? Because we don't get to earn net returns or gross returns, we get net returns. These are all the expenses I list that as investors have, and for taxable accounts, we have taxes. In every case, who has higher expenses? Active. So who must have lower net returns? Active. So now let me point out, does it matter an iota if this is small cap stocks where they say I can add value, it's inefficient? It's crap. Total nonsense. Anyone who says that should be required to wear a shirt that says I can't add. Look, it's simple math. William Sharp wrote it in a paper years ago, 3 pages, you can read it, The Arithmetic of Active Management. If small caps earn 10, I own DFA small cap fund, I've got to get 10. What do active investors have to get collectively? 10. Now, some might get 12, but if some got 12, someone got 8. Collectively, they must do worse because they have more expenses. Make it a bear market. Active investors can protect you in bear market. I'm sure you've all heard that. That's nonsense. It can't be true. Because if that number is minus 10, Yes, index funds go down in bear markets. That's minus 10. What does that number have to be? Minus 10. In fact, the evidence is actually slightly worse because of all these things. Active funds, despite the advantage of being able to hold cash while index funds are always fully invested, they've actually done worse in bear markets than they do in bull markets. That's what the data shows. So in summary, if you invest in actively managed funds, you have the hope of outperformance. However, the evidence demonstrates it's much more likely that it will be a poor experience, meaning it's the triumph of hype and hope and marketing over wisdom and experience. You don't believe me? We said before, the greatest mutual fund manager of all time, you all said, was Peter Lynch. Read what he said in a moment of honesty. And my book is filled with quotes from professional investors' legend in moments of honesty admitting that they pulled the wool over your eyes. Read what he says for yourself. Of course, he never said that while he was working for Fidelity when he was collecting big fees. Who would you say is the greatest, most legendary investor of all time? If you wanted to take advice from one guy or woman, who would you take it from?
Buffett.
Warren Buffett, right? I happen to agree. John Bogle, I have as great a respect as I have for any man. He's contributed as much to individual investors as anybody. He happens to be a great man, very humble. I've been lucky enough to have dinner with him and sit on panels. And he's been kind enough to endorse my books, having read them. Here's what's amazing to me, is that everyone says Buffett's the greatest investor, and they do exactly the opposite of what Buffett does. Now, does that make any sense to anybody here? Should you listen to the advice? Here's what Warren Buffett said you should do. He said exactly what I told you, and he said exactly what I showed you in the math. Think you ought to listen to Warren Buffett? Last thing I want to show you, this is another study. Very quickly, since we're running out of time, I'll just walk you through a little bit of modern portfolio theory. My books go into this in detail. A lot of people tell me this is their favorite part of the book. So here's a bigger study on pension plans. It covers 18-year period. The average pension plan we know has an asset allocation of 60% stocks, 40% bonds. What that means is I've got $100,000, $60,000 in stocks, $40,000 in bonds. I can easily replicate that simply. $60,000 in an S&P 500 index fund, $40,000 in a Barclays broad bond market fund. No stock picking, no market timing, nothing, just rebalance the end of each year on December 31st to get back to 60-40. That portfolio outperformed 71% of the pension plans who have huge advantages, much lower costs, etc. This study is incredibly biased against what I'm trying to tell you, and still 71% fail. Why? First of all, as I said, they don't even pay taxes. You do most of the time, unless you're in an IRA type account. Number two is they pay much lower fees than you do. So your numbers would look worse even if you invested in the same funds. Number three, this is all S&P 500. If you remember what I showed you earlier, the S&P 500 has underperformed value stocks and small value, emerging markets, others. Riskier asset classes over the long term have provided higher returns. Not always, but over the long term. Okay? If we properly risk adjust it, like I did with the SEI and Russell versus DFA, this bar goes over here, somewhere around here. That means you outperform like 95% of all the funds, and no stock picking, no market timing. Anybody here think that's a worthy goal, that you could beat 90+% of the great investors who have big advantages? And look how much your life has improved because you don't waste any minute watching Kramer. Look at the money you'd save on Tylenol, right? Let me show you how we build portfolios. This is not exactly how we do it, but show you the benefits of modern portfolio theory. So here's portfolio 1. We're going to go through portfolio 5, making some changes, and end up at portfolio 6 very quickly because we've got a few minutes left. Here's that P1, that portfolio, but a much longer time frame. Now we're going to go to 73 through 10. That's as far back as I can go to get the data. So that portfolio earned roughly 9.5%. That's the standard deviation level of volatility. That's how much $1 invested gave you 31 times your money. Anybody here would have been unhappy with that? Anybody get 31 times their money in this room? Everybody could have done this. Simple. Slept better too, right? And you don't have to take any calls from your stockbroker either, right? And that's what's called the Sharpe ratio. That's the measure of risk-adjusted returns. Now I'm going to walk you through to 2, 3, 4, and 5. Ignore the order. If I change the order of these things, the numbers would change a bit. All we care about is where we end up. I'm going to apply some tenets of modern portfolio theory. The academic research, including a paper I co-authored with Kevin Grogan, who co-authored a book with me and is my assistant. Kevin, we found that investors who have moderate equity allocations to conservative ones should not own longer-term bonds that are in this kind of index. We think you should stay shorter. Dampens the risk. You give up a bit of return, but it dampens the risk more. So we just use a one-year Treasury index. I don't think you need to go that short, but there is no 2-year index or 3-year index. So we use a simple 1-year index. Then we're going to cut things in half so I can't be accused of data mining, because obviously I could look back and say the best portfolio would have been 18.2% of this, 5.9% of that. I'm going to cut things just in half so I can't be accused of data mining. So I'm going to use half of my large caps and add small caps. I should get higher returns because they're riskier, but I also should pick up a diversification benefit. Sometimes small caps do better, sometimes worse. If I rebalance, when small caps do poorly, like they're doing this year, I get to buy them low. When they do great, I get to sell them high. That's the exact opposite of probably what everybody in this room does, because that's, I know, what most investors do. So then I'm going to take half of my large cap growth stocks, like those in the S&P, and buy large value stocks, really risky companies like Ford Motor could go bankrupt, bank stocks, and then buy the really super risky small value stocks. I'm still 60-40, and now I'm going to stay 60-40, but I'm going to move half of my US into 2 international indices, a value and a small cap. Still 60-40, added lots of risk by adding small cap, value stocks, etc. Hopefully I got better returns. What happened? Wow. Increased my returns on a relative basis, I don't know, looks like about 18%, 1.7% or so in absolute terms. Volatility went up maybe 3%. Anybody here dislike that trade? 55 times your money, no stock picking, market timing, sleeping well. Sharpe ratio up 1/3. So risk-adjusted returns. Now a little magic. Anybody here like to own commodities, those really risky, highly volatile stuff? That's because people think of things the wrong way. You should never think of an asset class in isolation. Commodities are highly volatile. But let me show you what happens when you add commodities to a portfolio and regularly rebalance. We just add 4%, taking like 1% away here and here, and 0.5% from those, so 2% from US and 2% international. Look what happened. We lowered returns from here a drop, but now we are beating this by 1.6, and the volatility is less. We got like 15, 16, 17% higher returns and about 3% less risk. Look at the Sharpe ratio now. No stock picking, no market timing. That's the benefits of modern portfolio theory, using the science of investing and getting to enjoy your life a lot better. So these are the kind of portfolios we build. We only use them as starting points for discussions because we think there is no one right portfolio. We call them lifestyles. So from conservative to aggressive, these are the funds we use. If you own any one of these portfolios, you have probably the most diversified portfolio of anybody you will ever meet, about 12,000 stocks. So if Enron goes bankrupt, you could say, yeah, I owned it, but it's so minuscule it made no difference in my portfolio. And if someone tells you, gee, I own Caterpillar and had great returns, you know what you can say? I own it too. Right? You own 12,000 companies, and we want you to own some of everything. Now someone could say, you know, Mike, I sat down with you, these make me really nervous, this 4% of emerging markets. Mike or I would tell you, here's why we think you should own them. Don't look at them in isolation, just look at the portfolio. I can't sleep well. All right, if that makes you sleep better, we'll take this 4% and distribute it around here. May not be as perfect as this one, but it's good enough. You still will own 11,000 stocks and broadly diversified. So we work to tailor portfolios to your individual situation. I'll just wrap up by showing you one last slide. Here's returns of those portfolios depending upon whether you're conservative or aggressive. Last 10 years, market S&P got 1%. Anybody unhappy with that 8.7? If you were 40-60, you got 40% equity, you still got 6.5 before any of the fees that we would have charged for the advice, which would include help with estate planning, insurance, and other things. You can see modern portfolio theory used right. Passive investing does not get you average returns at all. It gets you market returns, which by definition, are used properly, get you way above average returns compared to the average investor. I think it's worth taking one more minute or so. I'll tell one last story and then we'll take questions. This is my favorite story. Hopefully the evidence has convinced you, but I'd like to conclude what I think is the most important story at all. Hopefully the evidence, and you read my books, I would urge you, those of you who are really interested in the science of investing, go to my blog at CBS Money Watch. It's easy to find. Bookmark it. You can sign up for an RSS feed. 2 or 3 minutes a day. You'll get the science of investing. Not my opinions, but evidence from research. And you won't have to read what I call the investment pornography put out by Wall Street and the media. Okay? So here's my story. Okay? Hopefully I convince you that this is the right strategy. It'll certainly save you lots of fees. You'll sleep better. You'll have finally a strategy that makes sense. It's all common sense. You read the books, you'll say, gee, this makes sense to me for the first time. But let me tell you a more important story. So, professor is guest lecturer at Stanford University. Bunch of bright, eager MBA students. She's an expert on time management. She gets up in front of the podium and she pulls out a big box. Out of it is this monster pitcher. And she then opens another box and pulls out big rocks and puts the big rocks in until not another big rock could fit. She asks the class, is the jar filled? And they all shout, yes! And she says, oh, really? She pulls out another big box, and out of it she puts big gravel, pours it in between the rocks, until not another speck of gravel can fit. And she says to the class, is the jar filled? And they say, no. Very good, class. She pulls out a box of sand and sprinkles the sand in, till not another grain of sand can fit. And she says once more, is the jar filled? And what does the class say? No, right? What does she do? Pours water in until not a drop of water can fit in. And she then asks the class, what's the moral of the story? And one bright, eager MBA jumps up and says, no matter how busy your schedule, you can always fit in one more meeting. I'm always reminded of my doctor while I'm waiting there freezing naked in his office, right? While I tell that story. Anyway, she says, obviously that's not the moral of the story. The moral of the story is this. You have to figure out in your life which are the big rocks. Because if you don't put them in first, you can never get them in. Now, as I said earlier, if you're an active investor, what are you focusing on? The sand, the gravel, and the water. If you're a passive investor, you get to come home and focus on the big rocks, your family, community service, whatever is important in your life to you. So hopefully I've convinced you that passive investing is not only the winner's game in investing, it's far more likely to be the winner's game in life as well. So even if you're one of those few pension plans that managed to outperform a proper risk-adjusted benchmark, or you're an individual who's done, the price may have been you lost a far more important game of life because you were picking stocks, reading the charts, etc., instead of reading a story to your grandkids. Thank you very much. Hope you enjoyed it.
If you're talking to an 80-plus-year-old, how would you adjust your speech tonight? I know you stick pretty much with equities. I know you had bonds in there too, but how would you adjust?
Well, I think the answer to that is pretty simple. First of all, I wrote a book called The Only Guide You'll Ever Need for the Right Financial Plan. It walks you through all the questions you should ask to answer that question. How much equity you should have depends on lots of things, not just age. That's a really bad mistake that people make, because age is just one of the things that matter. Okay? 3 things you should look at, what I call the ability, willingness, and need to take risk. Ability includes investment horizon, which people think of. So the longer your horizon, the more ability you have to wait out a bear market. So you get older, you have less ability. But ability should also include something virtually no professional advisors that I know ever ask. I go around the country teaching professional advisors how to be better at what they do. One of the things they should ask is, how does your labor capital correlate with the risk of stocks? So a simple question is, you're a tenured professor at Bradley University, you're 40 years old, or you're a construction worker who's 40 years old, who do you think can take more equity risk? Tenured professor, because you have to ask the question, am I a stock or a bond? The tenured professor's labor capital is much like a bond. Doesn't matter what's going on in the economy, he's getting sort of an annuity, if you will. It maybe gets adjusted for inflation this year. The auto worker, the construction worker, the salesman, right? His income is going up and down with the economy. He might get laid off at the same time the market's getting killed. He's got to sell stocks to put the food on the table. That's a disaster. So that's one thing. Willingness to take risks is how much stomach acid you can take and not panic and sell, and even worse, you need to enjoy your life. So even if you don't panic and sell, you worry so much, you can't enjoy your life. You come home and you start yelling at your kids or your wife because you're nervous about the market. You've lost a far more important game. Need to take risk. And by the way, here's a rough number. If you can't take more than a 20% loss, you shouldn't be more than 50% in the market, period. Rough number. Okay? Third thing is need to take risk. Okay? I've already got him $10 million. Good rule of thumb at age 65 is 4% of your portfolio. So I got $400,000 a year and adjusted for inflation. So next year, if inflation's 2%, I could take $408,000. If I'm only spending $150,000, why am I taking any equity risk at all? Another point. But you have to ask the question, who am I investing for? You might be 80 years old and you have more than enough money. You don't spend that much. It often gets hard to spend money when you get much above, say, 80 years old. You can't travel as much easily and other things. Okay? So you're saying, let's say I've got $3 million. I only spend $50,000 a year plus my Social Security. I'm in great shape. I'm really investing for my grandkids. What's my horizon now? So you might say, well, I need $1 million to generate my income, and I'll invest that very conservatively, maybe 20% in stocks, and the other $2 million I'm going to invest for my grandkids. Or I may be leaving it to a charity when I die. 100-year horizon, or maybe infinite. A good advisor asks those kinds of questions 99.9% of stockbrokers and even other professional advisors, in my experience, never ask. Those are the kinds of questions I try to address in my book, The Only Guide You'll Ever Need for the Right Financial Plan. So age is only one component, but you come down here. We have 80-year-old clients with 60% equities, and we have 30-year-old clients with 20% equities because they have unique needs, ability, and willingness to take risk. Answer your question?
Very good.
Thank you. We got a question there?
Yeah, I've been an indexer for quite a few years, and I love...
How about a hand of applause for their winner, right?
I love watching CNBC when a broker gets on and says, well, if you were in the S&P 500 in 2010, it's been a zero. Something for you. They ignore reallocation.
Well, a couple of things. And then I'll let you finish. But they confuse indexing with the exclusive use of an S&P 500 index fund. Here's the 10 years, right? We showed you this. The S&P made 1% a year from 01 through 10. If you were 100% portfolio in that one I just showed you, you made 8.7. Right? If you were just 40% in stocks, you still got 6.5. That's a problem. They lie, if you will, because they want you to believe that indexing is all about only an S&P 500 index fund. That's not a prudent strategy. That's 500 stocks out of a global market of maybe 15,000.
Anyhow, how often
You're the guy who bought that book.
Merry Christmas. Anyhow,
My wife thanks you.
I tend to do it either quarterly or annually, and I skipped the last quarter because high-frequency trading is really jockeying the market around, and it took it up about time to reallocate. How do you really, is there any sub-rule that you would use to know when it's really?
I thought you read my book. First of all, there's nothing really wrong with quarterly or checking quarterly or annually to rebalance, okay? And I certainly would recommend you do it at least quarterly, not necessarily more than that. But time-based rebalancing makes no sense at all, okay? Because here's the important point. You have an asset allocation, say 60-40, because you determined that's the right one for you. There is no right number. There's one right for you. And these asset allocations that I showed here aren't right for every one of our clients. They don't represent every one of our clients. Everyone might be a unique one. We have discussions around who should own more small value in real estate and emerging markets, all those kinds of things. So that's rule number one. However, if you determine 60-40 and maybe it's this allocation that's right for you, then tomorrow it's right for you, isn't it? And the next day it's right for you. And yet the market is moving and changing it from 60-40 to maybe 62-38 or whatever it is. Now, in a world where there was no cost to rebalance, no trading costs and no taxes, and let's assume there's no cost to your time, which obviously has real value to you, you should rebalance every day, because otherwise you're letting the market control what your asset allocation is, which makes no sense. But we do have costs, we do have taxes, and we do even have, of course, value in your time. So I think a reasonable rule, the way we do it, is risk-based. So at 60-40, we have a rule that we will take that down to 55%, so 5% up and 65 down before we will rebalance. Doesn't matter what the time frame is. And then we'll do the same thing at the major asset classes, so that would be 35 and 45. But at individual levels, 5% this could go to 0, we don't like that. Or it could go all the way to 8. So what we do is take 25% of the absolute number. So that would be 25, and that would be 0.75. My math is right. And so you'd have 3.75 and 25%, yeah, 3.75 and 2.25. And then we'll measure there. So we check at the stocks versus bond level. We check at the U.S. versus international. So here it's 60% U.S., 40% international. And by the way, we have clients who are 50% U.S. and 50%, not 60-40. And then we check at the individual level. And we do it risk-based. One other thing I'll add. Every time you have new cash, you should use that to rebalance, always buying the losers. So that saves in taxes because you don't have to sell winners and maybe pay capital gains taxes. And if you have transactions costs, you're only doing one trade, the buys, and not two trades. So that's another hint. A third hint would be, don't take, unless you've got really small accounts, don't reinvest your dividends because that's the easy thing to do, or distributions. Take them in cash, and when you get them, what should you do? Rebalance, buy the losers, right? Okay, so what's the big benefit? Rebalancing forces you to do what? It forces you to be exactly like Warren Buffett. What does Warren Buffett say you should do? One, first of all, he says you should ignore all forecasts about the market, because a forecast about the direction of the market tells you nothing about where the market's going, but a whole lot about the person. He says, number two, I make more money when I'm snoring than when I'm awake. And number three, he says my favorite time frame for holding stocks is what? Forever. Okay? So, people love Warren Buffett, they want to emulate him, but they don't do what he says, right? How crazy is that? They do exactly the opposite. So, but if you rebalance, you become Warren Buffett. What does he say? If you're going to try to time the market, you want to be greedy when everyone else is what? Panicking or fearful. So you buy when, we were rebalancing on Monday. The markets have gone down so much that it caused us the need to buy stocks. What are you, crazy? We're going to buy, the market's falling apart. We told you this is going to happen. Now we want to buy low. You like buying low or you like selling low? We rebalanced. We got a little lucky this time, right? And the markets are now up, 450 points in 2 days. Could have gone the other way, of course. But over the long term, buying low and rebalancing, and you sell your good outperformers, what are you doing? Selling high. Does that sound like a good strategy? You become Warren Buffett. You become take the chips off the table when everyone else is getting greedy. Simple. Just rebalance. You don't have to make any forecasts. You become a genius. Any other questions? Got one over here. Can you stand up so people can hear you?
How would you suggest transitioning from active management to passive?
In general, okay, here's a rule to give you. Now, this is in the absence of costs, including taxes. And I'll try to think of a few exceptions. Always ask yourself this question. If I didn't own an investment today, would I buy it? So, for argument's sake, anyone in this room sitting with a few million of Caterpillar stock, in my mind, is crazy. Okay, because, Caterpillar may be a great company, but you've already won the game, you've got more money than you need, why are you taking the risk? And the strategy to get rich, maybe to concentrate risk, is entirely different than the strategy to get rich. You're now in the preservation of capital, and there's nothing to say that Caterpillar can't be the next Shell Oil, Enron, MCI, Kodak, Polaroid. I can list you 50 of the greatest companies in the history of the world, all of whom have gone to zero. Can happen. One bad mistake by the CEO, earthquakes, whatever can happen. Right? So yeah, should I ask yourself, if I didn't own those actively managed funds today, say your portfolio is worth $1 million, and God handed me $1 million, what would I do with it? If you wouldn't buy them, get rid of them immediately. There's no reason to hold them. Makes no sense. It's called an endowment effect. You hold things because Grandpa owned the stock and he wouldn't want me to sell it. The stock certificate doesn't know you. It won't hate you if you sell it. Now, a couple of instances. The gentleman over there is 80 years old. I'm making this up. He's got cancer. He's going to die in a year, and you pay a big capital gains tax. That wouldn't make sense. You can get a step up in basis on death, avoid the taxes, especially now if you're under the estate tax limit on taxes. What I would do is go hedge the stock, buy a put on the stock or something like that to hedge the stock for the year you expect to live. So there are exceptions. You got a big capital gains tax to pay. You may want to think about deferring some of that. But absent reasons like that, there is never a reason to hold it. I teach that mistake. It's called the endowment effect. You need to stop thinking about, I got it. Should I continue to own it? If you wouldn't buy it, you need to sell it immediately. Because otherwise, what you're doing is making the decision to continue to buy it. Every day, you're buying it because you can sell it. There's nothing holding you back. But taxes could be the big issue. Trading costs are nothing, right? Basically, it's either zero if it's with a fund, or if it's with a Schwab, it may cost you $20, $30, something like that. Got a question here, Don?
Earlier in the slide presentation, you showed some DFA funds that outperformed.
Well, they outperformed the SCI and Russell funds, right?
So were they just lucky?
No, it had nothing to do with luck. They had lower costs, basically. The rest of the difference was extra costs by the other guys. Let me say it this way. Active management isn't bad because they're dumb. Active management is bad because it's expensive. That's the only. Now, let me say this. Indexing is a great strategy, but there are problems with indexes, okay, that you can improve on. I've written several blogs. I would urge you to go to my site, but let me give you some minor examples, okay? Let's say you have read all the academic literature and you find that penny stocks have lousy returns. IPOs have lousy returns. Stocks and bankruptcies, 1% of them ever pay a penny to equity investors. Would you want to buy those stocks? What do you think? And yet, if you're an index fund and they're in the index, you keep buying them. DFA says we don't have to match just because they're an index. We educate our investors to say we're going to willing to accept tracking error. We won't look like an index. Some years because of that we'll underperform. Some years we'll outperform, but on average the research suggests we'll outperform. DFA's funds screen out hundreds of stocks because of that. That adds 40, 50, 60 basis points a year. Here's another example. I don't know if you know, but the Russell 2000 is actually the 2,000 smallest of the 3,000 largest. So if you own a Russell 2000 fund, let me ask you this question. What's your name, sir?
Randy.
Randy. You think there's any difference in risk and then therefore the expected return of stock that's ranked 1,001, so therefore it's in the Russell 2000, and stock that's ranked 999? Makes no difference, right? I agree. The risk and the expected return is the same. So if you own a Russell 2000 index fund and a stock is in that ranked 1,001 and there's another stock ranked 999 on June 30th when they reconstitute, then comes the next May 30th when they reconstitute to start it again, they reversed order. The 1,000th one is 999 in reverse. Now what you have to do to match your index is to sell the 1,001 because it's 999 and reverse. You got two trades. You got to pay capital gains taxes, maybe. Does that make any sense to you? But that's exactly what an index fund would do. DFA said long ago, that doesn't make sense. What we'll do is we'll create buy and hold ranges. I'm making this up because they don't replicate the Russell 2000. So they would say, we'll buy stocks that are ranked 1,001 through 3,000. If a stock moves up anywhere up to, say, number 800, above, so it gets below 1,000 into the 900s, we will stop buying it, but we won't sell because that makes no sense. So we'll have a little bit of tracking error. Some years the stocks that we continue to hold will underperform. Randomly, some will outperform. But we'll be much more tax efficient and we'll have lower trading costs. Big difference. One other thing I'll mention as another way they add value. If you're an index fund, you get $1 million come in, you have to buy the stocks in the index in the exact proportions. DFS says, that's kind of dumb. Here's what I can do, all right? I don't have to own exactly the stocks in the exact weighting. So I own, in a small cap index, 2,500 stocks. I know that, let's say there's a stock trading at 10 bid at 10.5 asked. And that stock trades only $1 million a day. But you got Fidelity small cap fund, they've built up a position of $10 million. Now they want to get out because their analyst says, this is now a dog, we got a better stock we want to buy, we need to get out. Do you think that with a stock that trades $1 million a day, they're going to try and sell that 10 million? What would happen? The stock would collapse. If they start hitting the bid for like, say, 100,000 and it would drive, and they keep pushing it down. So that's not what they do. They're smarter than that. What they actually do is call up a market maker and say, find me someone who'll take the whole block. One shot. I know I'll have to eat a discount, but if it's not too big, I get the speed and I get out. So they call up a broker or market maker. The market maker knows DFA at one time was the largest trader in the world of small cap stocks, even though it's a passive fund. What they say is we're willing to own randomly, we don't do any picking. If we should own X of a stock, we're willing to own as little as a half X. So if it's, say, 20 million, we're willing to own 10, or as much as 40, twice, randomly. If we could buy below where the market is, we'll take it. Someone's handed me a gift. Now, if I buy more, randomly, some of them will underperform, some will outperform, but I like buying below where the market is. So DFA looks at about 200 of these a day. They bid on 20 and they win 5. So they make, stock is trading at 10, they put in a bid at 9.25, and they get it. Because they said, I can hold 20 is my target, I could buy 10, I'm not at 40. And then they just don't buy more until, they get back to more normal. That block type trading, providing liquidity, especially when markets are collapsing and active funds must sell because people are redeeming. DFA will put in bids well below the market and often get them. It's almost impossible for index funds, can't do that. There are some other things. If you're an index fund, a stock leaves the index, you sell it even if it's a short-term gain. Now, why would you do that? Just wait for maybe a week. You maybe have a long-term gain, right? So there are some things that could be done. Indexing is good, but there are ways to minimize the negatives of indexing and maximize the positive. DFA has found ways to do that and has outperformed Vanguard similar funds in many areas.